I believe that, like the decade of the 1970s, that the purchasing power of the US dollar likely declines some number, like 70 or 80% over the next 10 years. If that's true, I suspect that past is prologue with regards to the gold price. Putting a real number on it, I don't want to do it, because you get these weird internet headlines then. Rick Rule says gold's going to 20,000, some stuff like that. But I think your listeners need to think about what the probability is that we solve the problem with regards to debt and deficits.
In today's episode, Rick Rule, a well-known resource investor, emphasizes the importance of gold and silver as essential tools to preserve wealth, especially during times of economic uncertainty. He believes the rising interest in these metals is driven by growing concerns about inflation and the weakening purchasing power of major currencies like the US dollar. Rule highlights that even though central banks have been increasing their gold reserves, retail investors have yet to fully engage with the gold market. However, he expects this to change as inflation becomes more evident in everyday expenses. According to Rule, gold does not need to replace the US dollar or other currencies to see significant growth. The market share of gold and silver in investment portfolios is currently less than 0.5%, far below its long-term average of 2%. Simply returning to this historical norm would cause a fourfold increase in demand for precious metals. Rule stresses that gold's value tends to rise as the US dollar loses purchasing power, making it a reliable store of value rather than just an investment to profit from. Looking ahead, Rule predicts a potential rise in the price of gold without the need for a financial crisis or the collapse of the US dollar. He points to past trends, noting that gold has historically kept pace with inflation. As inflation intensifies and more investors look for ways to protect their savings, he anticipates that the price of gold could increase significantly. Although he avoids putting a precise figure on it, he believes the long-term trend points toward a much higher valuation for gold, possibly 6 or 7 times its current price. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and share this video with a stacker. Enjoy the episode. Enjoy the...
I want to address that because you talk to a precious metals crowd, and the precious metals crowd is too simplistic on occasion. There is this suggestion that gold will somehow replace the US dollar as a medium of exchange or replace treasuries. That doesn't need to happen, and it likely won't happen. The market share for gold relative to other savings and investment assets in the United States, the market share for precious metals, gold, silver, platinum, palladium, gold stocks, platinum stocks, all this stuff, is less than 0.5%.
Right.
0.5% of total savings and investment assets in the United States is comprised of precious metals and precious metal securities. The 4-decade mean market share is 2%. If precious metals just reverts to mean, demand grows fourfold. Don't confuse yourself as a precious metals investor with the collapse of the US dollar or the replacement of the US dollar as a medium of exchange by gold. Likely not going to happen, and doesn't matter. If we merely revert to mean, we have the type of bull market that we had in the 2000 to 2010 period. It's important that people understand that. It's important that they don't hold their breath for the renunciation of the US dollar and the collapse of the US Treasury market. Not a requirement, not likely to happen in my lifetime, and I'm 71. Also, completely irrelevant as to the performance of your gold and your gold stocks. I think it's important to note that the gold run has happened without retail participation, mostly. It's a function of foreign central bank buying. By the way, that is in itself responsible for a lot of the delta between the move and the gold shares. Gold went up because central banks were buying it, and central banks don't buy gold shares.
Right. Not even the
If
Swiss.
the markets are different, it makes perfect sense that the response would be different. Usually, gold going up in US dollar terms is a precondition for a gold bull market. We've been in a gold bull market in other currencies for 4 or 5 years because the U.S. dollar has done well against them. And so gold has done better against them. But the idea that gold is going up in U.S. dollar terms, I think, is really evidence of the circumstance that I've talked about, which is to say the weaponization of the U.S. dollar. And for 15 weeks now, we have been in a period where there has been retail participation in the gold market. Maybe not at the bullion dealers like Sprott Money, but certainly if you measure the inflows into bullion-denominated ETFs for at least 15 weeks and probably 20 weeks, we've been in a period where there has been retail participation in the gold market too. If we get continued central bank buying, and if there's an overlay of retail buying, particularly retail buying in North America and Western Europe, then I think you begin to see precious metals pricing really get underway. And I would suspect that you're going to see that.
In today's news recap, silver soars as gold hits yet another record high. Precious metal prices stormed higher yesterday as investors flocked to safe places to store their money amid uncertainty over the U.S. election and tensions in the Middle East. Gold hit a record high of $2,740 an ounce, and silver topped $34 an ounce for the first time since 2012. Gold has risen more than 30% this year, while silver is up 43%. The rise in precious metal prices has been driven by expectations of further interest rate cuts by central banks around the world, as well as worries about the U.S. election result and conflict in the Middle East. The U.S. Federal Reserve and the Bank of England are widely expected to cut rates again early next month, while the European Central Bank did so last week. The People's Bank of China has also got in on the act, cutting rates yesterday in a bid to revive the world's second largest economy. Lower interest rates tend to boost the gold price because it becomes relatively more attractive to investors. Bullion is also seen as a safe asset in uncertain times. With 2 weeks to go until polling day, the U.S. election looks to be on a knife edge, while investors are also nervous about developments in the Middle East. The outlook for gold is quite bullish, said Joni Teves, a strategist at UBS, who is tipping it to hit $3,000 next year. He added, there are a lot of risks around the next few weeks with the U.S. election coming up. We could be in for some choppy price action. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Yeah, I think so. Craig, in the past, people have asked me on your show, okay, I get all this. When's gold going to move? To which I always respond, the year 2000. That's when gold's going to move. In the year 2000, gold was $253, and what is now $2,700?
Yeah.
So it's moved 8 and change compounded for 24 years. The problem isn't gold. The problem is investor perception.
Yeah.
And I would argue with you that most of gold's move hasn't been gold going up. It's the fact that the purchasing power of the U.S. dollar has gone down.
Right.
And unfortunately, until we deal with debt and deficits, I don't think that there's any upward pressure on the U.S. dollar at all. Upward pressure on the U.S. dollar relative to other currencies, sure. But in terms of real pricing, no. It's interesting that my estimate of the deterioration of the purchasing power is conservatively at 7.5% compounded.
Mm-hmm.
And gold has increased at about 8% compounded, which would suggest that gold really hasn't moved up a lot since the year 2000. It's merely kept pace with the deterioration in purchasing power of the U.S. dollar. I believe, Craig, that as the perniciousness of inflation becomes more felt in the average household, when more people stop thinking about the CPI at 2.6% and pay more attention to the price they pay for gasoline, the price they pay for groceries, the price they pay for their mortgage, the price they pay for rent, that not only will the reality be true, but the perception around the reality and the actions will be true. In the decade of the 70s, the perception of inflation didn't catch up with the reality of inflation for 5 years.
Yeah.
The writing was on the wall in 68. The reality began to be felt in 1972. Similarly, we didn't feel the increase in pressure in the U.S. dollar, which began to be evident in 1998, until about 2002. Gold actually started moving up 1999 and 2000, but nobody felt it. And I suspect in this circumstance that the delayed reaction will be the same, which is to say that investors, savers, voters in the United States have lived through 40 years of very benign economic climate. In the 1988 to 1988, 1982, I'm sorry, to 2022 timeframe. And I suspect it may take another couple years for people to understand what has happened to their savings and what has happened to their paychecks. And for them to understand that we're going to have probably a 10-year period in front of us with rapidly deteriorating purchasing power of U.S. dollar-denominated savings. And I think when that happens, when that perception coincides with the reality, that we'll see the same response that we saw in the period 2000 to 2010, which is the gold price escalating sixfold or sevenfold.
Yeah.
I don't want to make that a prediction. What I do want to say is that I believe that, like the decade of the 1970s, that the purchasing power of the U.S. dollar likely declines some number, like 70 or 80% over the next 10 years. If that's true, I suspect it passes prologue with regards to the gold price. Putting a real number on it, I don't want to do it, because you get these weird internet headlines then. Rick Rule says gold's going to 20,000, some
Tell me
stuff like
about
that.
it.
But I think your listeners need to think about what the probability is that we solve the problem with regards to debt and deficits.
Right.
If they then agree that the answer to that is nil, then they need to think about what happens to the purchasing power of their savings and investments in U.S. dollar terms.
What do you think of Rick Rule's take on gold and silver? Do you agree with his view that silver has the potential for a major breakout? Rick has pointed out that while gold is steadily climbing, silver's volatility presents a unique opportunity for those who can handle the ups and downs. He also emphasized that central bank demand for gold, particularly from nations like China and Russia, is a strong driver of future price growth. But when silver breaks out, Rule believes it could lead to an amazing financial circumstance for speculators. Let us know your predictions in the comments. Thanks for watching, and be sure to check out this next video. It's a perfect fit for you. See you there.